Hey, what's going on, everyone? Welcome back to another video. In today's video, I want to touch on some tax basics, break down a few ways these covered call high yield ETFs are paying out their taxes and their dividends, and how us as investors can go about trying to calculate them and figure out how it might impact our tax situations. First up, though, guys, as always, nothing here is financial advice. So, with that being said, please go ahead, hit that like button if you're enjoying these videos. And let's jump right into it. You guys, these are my holdings as of right now. And last year, they were slightly different. So my tax situation is a little bit different from last year because I did sell off a couple of funds, including GDV and HTAE from Harvest. But I will say right now, I did get my brokerage statement and checking out all of these different funds, you guys. Pretty much most of them paid out in capital gains or ROC. ENCC actually paid out the most Canadian eligible dividends, which still wasn't really that high in comparison to the capital gains and ROC. And then Canoe EIT, they had I think second most Canadian eligible dividends for my holdings. Actually would have thought that CDAY would have more, but they really had a small amount in comparison to their capital gains and return of capital. So, kind of just an overview of these holdings that I have. There was minimal amount of Canadian eligible dividends in comparison to how much income these funds are really paying out. So, having said all that, guys, I just want to touch on a few things before we jump into taxes, and that is the current situation in the stock market. It has been so different week after week. And, I even pull up like the news stories and the top stories, and it's like, stocks are rebounding, high hopes. And then, it's like timing the bottom of the real estate market. And, there's an anti-recession guardrails are getting weaker. Like there's just so much mixed information out there, you guys. And that's just why, in my opinion, it's so important to have that long-term mindset. And I know there was definitely people who over the last few weeks sold out of a bunch of stuff and got, panicked and sold and stuff like that. But I really feel like this high yield strategy with getting those dividend payments every couple weeks or once a month, whatever, really helps you stay invested because regardless of how much volatility there might be, week after week, month over month, you can see that things are still coming back. And history tells the tale that over time, as long as you can ride things out, you will be rewarded as a long-term investor. So that is my plan. But yeah, love to see these green days. Everything is up. Bitcoin, they've been slowly trending up. They're back up over $100,000 Canadian, but it's still, quite lower than what they were trading at a few months ago. So that is just a broad look in my take on what's been going on in the stock market lately. I am anticipating the S&P 500 will break 7,000. That's just my own take on that. But yeah, nice to see these kind of days out in the markets. Everything is up. Now, as far as taxes go, there's this calculator here from Wealthsimple. Basically, you can just like type in Google Wealthsimple tax calculator and it will come up. So then you pick your province. So I'm here in Alberta, but you could choose, whichever province you're in. And then these are just the fields you would type in. So basically my situation, guys, from last year, I got about 27,000 in capital gains, about 1,100 in eligible dividends. So you can see the eligible dividends are much, much smaller than the capital gains income. And if this number seems small to you, it's because there was a lot more income paid out, but it was all in ROC, return of capital. So that is not taxed at all. That would be taxed in the future if I were to sell off ETFs or sell off any of those investments that took on those ROC taxable income, right? So this is how it looks. So let's just say that I filed my taxes this way. This isn't going to be my final tax situation because I do have other income. I do have employment income. So I'm just, going theoretically here. If you had 27,000 capital gains and, $1,100 in dividends, basically, you guys, you can see that your tax liability is zero. It even tells you right here. if you make 28,000 living in Alberta, you'd be taxed zero. So you get a probably a hefty refund back, maybe. And then you can play with these numbers. Let's say next year those capital gains are up at 50, and those dividends are at 5,000. Let's say that's $55,000 in taxable income. But your tax liability is only 1470. So still, very tax efficient, as you guys can see. And again, a lot of these funds pay out in ROC, and that is not taxed until you sell those investments. So you're probably, depending on what you're invested in, those numbers may even be lower. And I wanted to go over a couple of things because all of these funds have declared their 2025 taxable income. So you can see here with HHIS, they paid out a total of $2.80 per unit in distributions, and return of capital ROC was over 60%. So they did have, about $1 of capital gains, but out of that $2.80, $1.76 is classified as ROC. Whether you guys think that's good or bad, that's just what it is, and they've got it out there. So if you hold HHIS, that is 62 or 63% of your distributions that you're not going to have to pay tax on until you eventually sell your shares one day, if that's what you decided to do. And you can find these on all the different ETF websites, you guys. Here is Evolve ETF. So you can basically go down to distributions, and then they have the T3 distributions and tax breakdowns. So you can see here some of their ultra yield ones down in the middle. They have Biggie here. So they paid out $2.18, and you can see that return of capital is $1.82, and then capital gains is 36 cents of that. So basically you can go down and check out any of the funds that you want. Here's Canny at the top, and Canny, their eligible dividends also very, very small, 0.04 cents out of their total distribution of $1.47. So, as far as eligible dividends, I found, at least this year, they're very, very small. And in my portfolio, you guys, like, I believe HDiv didn't even have any this year. Canoe EIT, they did have some. And then, like I said, ENCC actually found the majority of my eligible Canadian dividends this year came from ENCC and Canoe EIT. And, but even then, it's a small amount. So for what it's worth, you guys, that's just a quick look at taxes and, one of the many strategies that you can use to basically try to forecast some of your tax liability. I really like this calculator. You can change your province. So let's say you're in BC. I believe BC and Ontario are some of the better taxed provinces for capital gains. Correct me if I'm wrong, but let's just say you made $40,000 in capital gains. So you can see how it looks in different provinces depending on where you live. Anyways, you guys, that's a quick video on taxes. I am definitely going to be owing money this year in tax time because I did have a fair amount from my job last year, and then we sold a couple of properties, including one investment property last year. So I'll see how that all plays out here, you guys. But as far as these funds, I'm finding majority of return of capital and capital gains from pretty much everything here. So anyways, you guys, I hope you enjoyed this video. Please go ahead, hit that like button. Hope you're all having a great start to the week out there, and I will catch you guys on the next video.